What causes the clash between Elliott wave and Fibonacci traders? What causes the clash between Elliott wave and Fibonacci traders? We are on the monthly chart of PacWest Bancorp. Is my pronunciation correct? PacWest Bancorp. Epic PACW, Papa Alpha Charlie Whiskey. And we want to discuss what causes the clash between Elliott wave and Fibonacci traders. Well, ladies and gentlemen, the Fibonacci traders are very, very aggressive traders, and sometimes they can hold up the financial market. In most cases, they are winning, all right? And sometimes there is a clash between the Fibonacci traders and the area wave traders. So what I meant by Fibonacci traders is traders that are only using the Fibonacci retracement, the Fibonacci extension. Those traders do not care about Elliott wave or the stochastic or any other technical indicators. Stock goes up, all right, pull back to 50% Fibonacci retracement level. Those traders will place a trade to buy. This is their method, and they have their risk control, and that's what they do all the time. On the other hand, there is another group of traders that are using the Elliott wave. And though some of them, though it's very important for an Elliott wave trader to learn to master Fibonacci, and also important for a Fibonacci trader to learn and master Elliott wave, sometimes we have traders that are only using the Elliott wave principle and the wave patterns. And sometimes we have what we call the clash between the Elliott wave traders and the Fibonacci traders. All right. So we want to discuss the causes, what causes the clash between the Elliott wave and Fibonacci traders. As I explained to you before, following our guidelines when we are counting Elliott wave, the Elliott wave cycle is usually something like how should I put it? All right, a barcode number one. So normally number one is like this, isn't it? Number one, okay? The number one is like this, okay? But if I'm talking about a barcode, okay, number one, that's the way the Elliott wave cycle looks like. So price goes up, and then we have a correction. And if we do not have a complex correction, and the market environment is good, we may have something like this again, and then again we may have another correction. Yes or no? All right. So suppose you were here. All right. So you were here, exactly here, when the Elliott wave cycle has ended. The market environment was viable. All right. And the fundamental was solid for this stock, PacWest Bancorp. All right. And you want to buy that stock right here when the Elliott wave cycle has ended. All right. Now, what usually causes the clash between Elliott wave and Fibonacci traders? One of the things that will cause a clash between an Elliott wave trader and a Fibonacci traders is the 50% Fibonacci retracement level of the corrective phase. So you see this corrective phase here, all right? Now, something is going on. So price went up, okay, and then it came down, okay? Remember, as the price was coming down first, which I explained already in another video, I don't know whether are they pro traders. There are others here at 50%. No, leave it that one now. I'll leave that one for now, okay? That's different. Okay, I'll move back to that. Okay, so price went up, okay, now it's pulling back. It pulled back all the way here, okay? So everybody's happy. Now, an Elliott wave trader start counting wave. First wave, second wave, blah, 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 okay? But the clash will take place at a 50% Fibonacci retracement level of the corrective phase. Where is the corrective phase? From here to here. So, whenever a cycle is completed, my friend, what you need to do is to highlight the beginning of the corrective phase of that cycle and the end of that corrective phase. You must also highlight the 50% Fibonacci retracement level of that previous cycle. 50% Fibonacci retracement level of the corrective phase of that cycle. Repeat, the corrective phase only, all right? Not the trending phase. Highlight the beginning, the end, and the 50% Fibonacci retracement level of that corrective phase. The reason is, as you start counting your wave at the beginning of a new cycle, all right, you want to know where is the 50% Fibonacci retracement level of the prior correction, because very often there is a clash at that 50% Fibonacci retracement level between the Fibonacci traders and the Elliott wave traders. In the mind of a typical Fibonacci trader, all right, if a stock is very important for trader to understand, especially if you are trading Fibonacci, if a stock goes down from A to B, all right, and it rally up to the 50% level, Fibonacci traders want to sell it at 50% Fibonacci retracement level to form what we call the ABCD chart pattern. Did you get that? Whenever a stock goes down from A to B, and that stock rally up to 50% Fibonacci retracement level, remember there are always place at that 50% Fibonacci retracement level to sell or to buy, depending whether we are in an uptrend or in a downtrend. If you forget this, you will get involved with a clash with Fibonacci traders. If you are a typical Elliott wave trader. So, with that information, if you look on this chart here, you can see that here we have a trending phase. This stock, Pac West. It's a quite difficult name to pronounce. Pac West. Well, so we have a trending phase. So stock went out from here to here. What is the correction? The correction start from here, 1, 2, 3 down. So all this move down. So in fact, we have 100% retracement. It canceled it, so it didn't stop somewhere halfway. It canceled it completely. All right, it canceled the previous trend. The correction has canceled it. So what you need to do is to highlight the beginning of the correction. The last part. This one, especially the last part. Sometimes they may say here, but especially the last part. This one that bring it down like this. Highlight the beginning and the end of that correction, all right, and you will also highlight the 50% Fibonacci retracement level, because very often there is a clash between the Fibonacci traders and the Elliott wave traders. So the turquoise line represents the 50% Fibonacci retracement level of the prior correction. Now you can see that after the correction, the price formed a double bottom chart pattern here. So as you are here, you start counting your wave, all right. So price went down and formed a double bottom chart pattern. So your first wave, and now you are counting your second wave, 1, 2, 3 down. Did he cancel it? Almost cancel it. So you say, Joe, it didn't cancel it. I'm happy with my wave count. And now you're going up, You're counting your Elliott wave. And then you go. You say, George, this is my third Elliott wave. By the way, this video is not about Elliott wave count. I'm explaining to you the clash between Fibonacci traders and the Elliott wave trader. And you do something like this. Or probably you have done it like this, something like this. And you notice that, the second wave has canceled the first wave. And then you say, no, that's not it. And then you say, okay, George, this is, the third Elliott wave here. And this is the first wave here. And so on, and so on, and so on. All right? Now, so you start counting your wave, first wave, second wave, and the third wave. All right? You are now in the third Elliott wave. But what I want you to remember is the 50% Fibonacci retracement level of the corrective phase. Because in the mind of Fibonacci traders, they will place orders here to sell around the 50% Fibonacci retracement level. You can see that as the price reaches that level, 50% Fibonacci retracement level. Follow my cursor. There were orders here to sell. The stock went down here, okay, on the dot. You see, exactly on the dot. You can see that they tried to sell it also at 38.2% in that zone. The aggressive Fibonacci traded. But the most important you can see here was not much. But at 50%, for 1 month the stock went down. The following month the stock went down a little bit before it recovered. So one of the causes between Fibonacci traders and Elliott traders is the 50% Fibonacci retracement level, where the Fibonacci traders usually place orders to sell. The reason is, which I explained in another video yesterday, that I posted 24 stock traders YouTube channel. The title of that video is question: why should one always bank profit near 50% Fibonacci? Check it out. YouTube search that video. Question: why should one always bank profit near 50% Fibonacci? That video I posted at 24 stock trader YouTube channel. Okay. In that video, I was explaining to traders that it's compulsory to take profit at 50% Fibonacci retracement level if you buy at a reversal point. So this is a reversal point. As the store, you bought it here at a reversal point. So now you see correction has been completed, probably from a double bottom pattern. If you buy here, which is a reversal point, okay, a downtrend, the reversal pattern, either double bottom or an inverted head and shoulder chart pattern. Those are the reversal pattern that we see at the end of a downtrend. You buy a stock at a reversal point and the stock is going up, be prepared to take profit when the price reaches the 50% Fibonacci retracement level of the prior action, which is in this case a correction. If you do not, you will be surprised. Sometimes the stock will go down from there. It happened to gold traders, all right, price did exactly the same thing and then just going down. Okay? Because the 50% Fibonacci retracement level is the dividing line between the bullish zone, which is above that 50% zone, and the bearish zone below. The reason why when you buy at a reversal point here, you must either secure your gains or bank your profit altogether. It's because the zone below the 50% is a bearish zone. So this rally is a rally in a downtrend. In fact, it's a rally in a bearish zone because the prior move was bearish. The dominant force, so to speak, is bearish. Price is rallying up in a bearish zone, and it reaches the boundary between the bullish zone and the bearish zone. The Fibonacci trader will come in aggressively. The bearish Fibonacci trader, because stock went down, now it's at 50%. They are quite aggressive at that point, creating a clash between the Elliott wave traders and the Fibonacci traders. Sometimes that clash can create an Elliott wave failure, which means, for instance, suppose you were here and those of Fibonacci traders managed to push the price down, you may have a wave count cancellation. So sometimes that's why you see that you may have to see that the price went up to a certain level and then you pull back completely to cancel a multi-wave. In that case, you will restart counting your wave. But the reason why sometimes you have an Elliott wave failure is not due to fundamental reason. It's just because of the clash between the Elliott wave traders and the Fibonacci traders at the 50% Fibonacci retracement level. This is about what causes the clash between between Elliott wave and Fibonacci traders. Now you get it, all right? And it is also powerful. The opposite is also true in an uptrend. If a stock goes up, okay, here we are. Let's clarify that before we go, so you get the whole picture, all right? If a stock goes up from A to B, as you can see on my chart, goes up from here to here, and it pulled back to the 50% Fibonacci retracement level. Fibonacci traders want to buy that stock. Before the price reaches that level, there are already orders here to buy. All right? So, what is happening, the takeaway here, so you will have first a downtrend. So you have a downtrend, okay? You count first wave, second wave, third wave, fourth wave, and a fifth bearish wave, okay? And then a correction has prepared the price somewhere here, so you have a bearish Elliott wave cycle is completed here. So but that bearish Elliott wave cycle has started here and has ended here, but the correction has started from here to here. Okay? You agree? So the correction from here, the corrective phase for that downtrend is from here to here. Okay? So what you need to do is to highlight the beginning of that correction and the end of that correction, and also the 50% Fibonacci retracement level of that correction. All right. What I'm doing is not correct here. Yes, that's correct. Okay, that's correct. Okay. So now, so you highlight the high, the beginning of the correction and the end of the correction. Okay, and you highlight also the 50% Fibonacci retracement level, because you remember that because here the correction was bearish, here the correction was bullish. Price was going up. So now as the price is pulling back to the 50% Fibonacci retracement level, remember what's going to happen. All right. The smart money know that when you sell a stock at a reversal point, which is this point here, all right, you sell a stock at a reversal point here, you must be prepared to take profit near the 50% Fibonacci retracement level. So those traders will be willing also to bank their bearish profit. So in order to close a bearish position, they must buy, so they become buyers. So a bearish trader is buying near the 50% Fibonacci retracement level. On the other hand, Fibonacci traders know that because the stock went up from here to here, and the price pulled back to the 50% level, they are quite aggressive and they want to buy. And the price may go back up. But at that point in time, you have noticed that the Elliott wave cycle has ended here. So in your mind, okay, let's call it now, okay? In your mind, you start, okay, counting Elliott wave from here. Okay, you start counting first wave, blah, blah, blah. But if you forget the 50% Fibonacci retracement level of the correction, you may be in trouble, because suppose you are in the third Elliott wave or the first wave up to this point, and you ignore the 50% Fibonacci retracement level, you ignore the clash between the Elliott wave trader and the Fibonacci traders, you may give away some profit, which you do not want to do. All right? If you have any question or suggestion, put in the comment section, and in due course I'll record another video to answer your specific question. This is about what causes the clash between Elliott wave and Fibonacci traders. The correct answer is the 50% Fibonacci retracement level, where aggressive Fibonacci traders want to buy or sell, depending that we are in an uptrend or in a downtrend. As an Elliott wave trader that is counting Elliott wave at the beginning of a new cycle, that new cycle that is starting from the end of the previous cycle, you need to highlight the beginning of the previous correction and the end of the previous correction, and also the 50% Fibonacci retracement level. As you can see here, as the store reaches that level, there was a kind of a pullback here. All right. Now what is happening, you can see that the clash between the Fibonacci trader and the Elliott wave trader is not finished. So you can see here, so you are here, you notice that, okay, you handle it carefully. Now you went above it and you retest it here, okay? All right, following my wave count here, 1, 2, 3, 4, 5, is it correct? You see here now, so you say, okay, retest it. So we are out of the wood. We are now in a bullish zone, okay? We are now in a bullish zone. Price went up. Look what's happened. Price going down, we may say there is a correction taking place here. Price now coming near the 50% Fibonacci retracement level. Look again the clash. How the Fibonacci trader push it again, all right, below. Here they failed to push it below. Now here you can see that they are attempting again to force it back below that 50% Fibonacci retracement level. Now you can see that the bullish trader came back and push it back up. So price stock went below the 50%. Now another go push it up above. There is a clash right now in this zone of 50% and Fibonacci retracement level. I need to add also that the 50% Fibonacci retracement level is the second most powerful Fibonacci key level. It's also a psychological price level. We are the TSTW24 traders talking about what causes the clash between Elliott wave and Fibonacci traders. Happy trading to you all, and speak to you soon.